why big banks can't actually fail. Imagine seeing headlines announcing the collapse of a large bank when you wake up tomorrow. Fear spreads. ATMs are empty. Stock markets fall. Governments rush to react. Suddenly, millions of people can no longer access their personal funds. The world seems to be coming to an end. The twist is that it never actually occurs. Not entirely. Not really. When a giant bank falters, it always manages to get back up stronger, bigger, and more dangerous than before. Why? Since these organizations are no longer just businesses. Their failure is a term that only exists on paper because they have grown into indestructible pillars of the world economy. At all costs, the system is designed to keep kids safe. And behind the scenes, out of your sight, every crisis, bailout, and market panic is meticulously planned. In this video, we're going to reveal why big banks can't actually fail, how the system quietly survives their mistakes, and what that really means for you, your money, and the global economy. Stay until the end, because the truth is far stranger and scarier than you think. Number 6. Your savings exist mostly as a promise. The funds that are in your bank account are not kept in a vault under your name. The majority of it is always moving loan to other clients, invested in markets, packaged into securities, and used as leverage in intricate financial products. Banks operate under the presumption that the majority of depositors won't take out all of their money at once. The entire system is based on this unseen faith. However, the illusion vanishes the instant confidence falters. They are defending the belief in the system itself rather than banks, which might cause modern economies to freeze in a matter of hours. Seldom do people understand that when they deposit money, they are lending it to the bank, which will subsequently multiply and invest it, frequently in highly risky ways rather than putting it in a safe. Your savings are essentially hostage collateral for a whole system that is based on trust. Number 5. Bailouts are the system's immune response. Bailouts are frequently presented as contentious, urgent solutions. They actually serve as the financial industry's automatic immune system. Central banks carry out pre-planned rescue operations rather than debating whether to take action. In order to stabilize markets, money is given, regulations are temporarily suspended, and liquidity is pumped. Inflation, growing debt, or declining currency value all conceal the expense from the general population. This leads to a perilous moral distortion. While risk at the top is rewarded, the repercussions are spread, absorbed, and delayed by common people. Trillions of dollars, for instance, were surreptitiously transferred into banks during the 2008 financial crisis via initiatives like quantitative easing and the Troubled Asset Relief Program TARP. While citizens paid the indirect expenses, executives and shareholders escaped nearly unharmed. Bailouts are evidence that failure was anticipated, designed for, and neutralized in advance, rather than an indication that the system failed. Number 4. Failure is carefully contained, not prevented. Big banks are allowed to fail only in a carefully orchestrated, controlled manner. Collapse is never absolute, it is contained and redistributed. Toxic assets are isolated, losses are shifted onto other institutions or absorbed by governments, and essential operations continue under new ownership or branding. Executives often resign quietly, and shareholders absorb partial losses, but the institution's core functions remain intact. To the public, it may appear as accountability. In reality, it's a way to reset the system while avoiding true consequences. This controlled demolition preserves confidence, prevents panic, and allows the bank to continue functioning as if nothing catastrophic occurred. Over time, this process becomes a pattern, banks take enormous risks, regulators intervene before things get out of hand, and failures are sanitized and recycled back into the system. True failure, a permanent, destructive collapse, is simply no longer permitted in a world where society is financially dependent on these institutions. Number 3. Regulators guard stability, not justice. Financial regulators are often portrayed as watchdogs, but in practice they function more like firefighters. Their primary goal is to prevent fires from spreading, not to investigate who started them. Many regulators have worked in the banking industry, and many will return, creating a revolving door that aligns incentives toward preserving stability. A true crackdown could trigger panic, systemic losses, and political backlash, so oversight tends to focus on risk management rather than meaningful accountability. Fines replace reform. Warnings replace enforcement. The priority is not justice, it is continuity. The system is treated like a fragile engine that cannot be stopped, even if it repeatedly malfunctions. Stability is prized over correction, and the public rarely sees the decisions made behind closed doors that protect giant institutions from the consequences of their own failures. Number 2. Finance is a web, not a line. Modern banks do not operate in isolation, they are part of a tightly woven global web of obligations. Derivatives, credit lines, insurance contracts, and interbank lending connect institutions across continents. One bank's failure instantly forces other banks to revalue assets, call in loans, and sell holdings to cover exposure. The chain reaction can escalate within hours, creating a domino effect that spreads through markets worldwide. This is why governments intervene early, often quietly. The moment one bank wobbles, authorities act before panic reaches the public. By the time the headlines report a crisis, the real battle has already been fought behind the scenes. The interconnectedness of finance means that the collapse of even a single too-big bank could bring down countless others, creating a scenario in which the entire system is at risk within a matter of days. Number 1. Every crisis makes the giants untouchable. Financial crises are not great equalizers, they are mechanisms of concentration. Smaller banks, unable to survive shocks, are absorbed or collapse entirely. Survivors emerge larger, more interconnected, and more indispensable to the global system than before. Each crisis reinforces the justification for protecting these giants at all costs. Over decades, this process has created a system dominated by a few behemoths whose failure would be catastrophic. The more powerful these institutions become, the more society depends on them, and the more impossible it is to let them fail. Crises, in effect, act as natural selection, eliminating the weak, rewarding the already powerful, and ensuring that the cycle repeats endlessly. Big banks cannot fail because the system has engineered failure out of existence for the largest institutions. Risk hasn't disappeared, it has been transferred downward, absorbed by governments, public debt, and ordinary people. Risk persists, and mistakes are repeated because true consequences are removed from those who make the decisions. The invisible cost of this survival is social, financial, and generational ordinary people pay indirectly for the mistakes and recklessness of the financial elite. If this changed how you see the financial system, like the video. If you want more deep dives into the invisible structures shaping your life, subscribe. And consider this final question: if failure is impossible for the powerful, who really bears the cost of their mistakes?